I've lost count somewhere along the line of how many market crashes I've weathered. 14, 15. What I find so fascinating is that each time people react as if it's a completely unprecedented event. They panic. I sit here in my familiar Omaha office at the same old desk, and I hear the whispers again. Pronouncements about an impending market crash. Maybe 2026, they say. The truth is, this isn't my first rodeo. I'm not going to pretend I have some crystal ball that tells me exactly when the next one will occur. Nobody does. Anyone who claims to have that kind of foresight is either being dishonest or trying to sell you something, probably both. But what I can offer is some perspective on how to approach it, how to prepare for it, and most importantly, how to capitalize on it. Because you see, a market crash isn't a calamity, it's an opportunity. It's akin to the greatest fire sale you'll ever witness. And if you're well prepared, that's precisely when fortunes are made. Let's rewind for a moment, back to 2008. The global financial system was teetering on the brink. Banks were failing, people were losing their homes, the stock market plummeted nearly 50%. I remember sitting in my office glued to the ticker. It was grim, truly grim. News outlets were proclaiming the end of capitalism as we knew it, drawing parallels to the Great Depression. But do you know what I was doing? I was buying. I invested in Goldman Sachs. I invested in General Electric. I poured billions into companies that everyone else was desperately fleeing. And people thought I'd lost my mind. Warren, what are you doing? The world is collapsing. My phone wouldn't stop ringing. People I hadn't heard from in years were calling to tell me I'd gone off the deep end. But I knew something they either didn't know or had forgotten in their panic. I knew that America wasn't going anywhere. I knew that solid, well-managed companies don't simply vanish because of a couple of rough years. And I knew that when fear grips the masses, that's the time to act. There's an old adage, be fearful when others are greedy, and greedy when others are fearful. I didn't coin that phrase to sound clever. I coined it because it encapsulates the entire game, really. And I learned that lesson the hard way, through decades of observing human behavior play out in the market. Now let me share my perspective on market corrections. Most people view a crash as a loss. Their portfolio shrinks by 30, 40%, and they feel impoverished, as if someone has reached into their pocket and stolen their money. But that's not how I perceive it. If you're not selling, you haven't actually lost anything. Those are merely numbers on a screen. The underlying companies are still operating, still producing goods, still serving their customers, still generating revenue, and often still paying dividends. What has truly changed? Only the price. And a lower price, well, that's advantageous if you're a buyer. Consider it this way. If your favorite breakfast cereal is on sale at the grocery store, half price, are you going to complain? Of course not. You're going to buy 2 boxes, perhaps 3, maybe even stock up for the entire month. Stocks are no different. When the market crashes, it's like the entire stock market is having a massive clearance sale, with everything marked down significantly. And yet, people stampede towards the exits, trampling one another in their haste to escape. It defies logic, doesn't it? But that's human psychology at play. That's fear. And fear, unfortunately, can drive intelligent individuals to make foolish decisions. Now, I'm not suggesting that you blindly throw money at just anything during a market downturn. That would be reckless. It would be akin to buying every item in the clearance bin simply because it's cheap. Some things are inexpensive for a reason. You still need to exercise prudence. You still need to understand what you're buying. But here's the crucial point. If you've done your research beforehand, if you've been following companies, analyzing them, understanding their business models, and patiently waiting for the right price, then a market crash is your moment. It's like being a farmer. You don't sow seeds in the midst of a drought and expect them to flourish. You wait, you prepare the soil, you monitor the weather, you get everything in order. And when the rains finally arrive, that's when you plant. The market operates in a similar fashion. You prepare during the prosperous times, and you act decisively during the challenging times. That, in essence, is the entire strategy distilled into a single sentence. Let me tell you about Coca-Cola. I acquired Coca-Cola in 1988, investing approximately $1 billion. It was the largest investment I had made up to that point. And people questioned my rationale. Warren, why Coca-Cola? It's just sugary water. What's so remarkable about sugary water? And I would respond, well, yes, but it's sugary water that people have been consuming for a century, and they're likely to continue consuming it for another century. You see, I can reasonably predict that. I can't predict the next revolutionary tech gadget. I can't foresee which social media platform will dominate in 10 years. Those things are too transient. They lie outside my circle of competence. But Coca-Cola, I understand Coca-Cola. People adored it in 1888. They adored it in 1988, and they still adore it today. That's a fairly reliable track record. That's what I seek. Straightforward businesses, businesses that are unlikely to vanish, businesses that even a moderately competent individual could manage. I once heard a line, I think it was from Charlie, that sooner or later, the market will crash. During the 2008 financial crisis, even Coca-Cola's stock price took a hit. But did the underlying business suffer? Did people stop drinking Coke? Of course not. They might have switched from restaurants to grocery stores, but they still consumed it. The stock simply became more affordable. And if I hadn't already been a shareholder, I would have bought even more. That's really the key, You don't need to chase the next tech stock or gamble on a startup hoping to become the next Amazon. You don't need to master artificial intelligence or blockchain. You just need to find those reliable, predictable, exceptional businesses and wait patiently for them to go on sale. I think a lot of people misunderstand investing. They see it as a way to make quick money. Trading frequently, timing the market, studying charts. That's not investing, that's gambling. Some people get lucky gambling, but investing is about owning a piece of a business and letting it generate wealth for you over years, even decades. It's about patience, and patience is the hardest part. When the market crashes, it feels almost impossible to stay calm. You watch your account shrink every day. Your friends panic. Your family worries about you. The news screams about the end of the world. Every instinct tells you to do something. Sell, get out, cut your losses. But the best thing to do is nothing, or even better, buy more. Let me tell you a quick story. Back in 1972, I bought a textile company called Berkshire Hathaway. Worst investment I ever made. Awful business, dying industry. I bought it because I was mad at the guy running it. Never a good reason to buy a company. I was young, naive, trying to teach someone a lesson. And you know what I learned? The market doesn't care about your ego. Anyway, in those early years, I was managing money for a group of investors. The market was all over the place, up one year, down the next, flat for years. Not a great time for stocks. I remember one of my partners, a really nice guy, a dentist or a doctor, I think, came to me really worried. He said, Warren, should we sell? Should we get out? I can't sleep. I told him, if you can't handle seeing your investments drop by 50% without panicking, you shouldn't be in the stock market. It sounds harsh, and I felt bad saying it, but it's the truth. The market will drop by 50%, maybe more. It's not if, but when. And if you sell every time it goes down, you'll never make money. You'll just buy high and sell low. That's the worst strategy. And yet, that's what most people do. So what should you do when the crash comes? First, don't panic. Easier said than done, I know. Even after all these years, with all my experience, a little voice still whispers in my ear during downturns, maybe this time is different. But it never is. It always feels different. In 1987, it was program trading. In 2000, it was the dot-com bubble. In 2008, it was subprime mortgages. Every crash has its own story. but the ending is always the same. The market recovers. So stay calm. A crash is not the time to make big changes. It's the time to stick to your plan. If you've been investing steadily, keep investing steadily. Don't stop. Don't try to time the bottom. Don't try to be too smart. Just keep putting your money in. It's called dollar cost averaging. Fancy term for a simple idea. You invest the same amount every month, no matter what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, it all evens out, and you do really well. Better than really well. You end up doing better than most professional investors. Second, make a list. Before the crash happens, sit down and write down a list of companies you'd love to own. Companies you understand, companies that make things you use, companies you think will still be around in 20 or 30 years. Write them down, study them, figure out what they're really worth. Decide what's a fair price, what's a bargain price. Then just wait. And when the crash comes and those companies go on sale, you'll be ready. You won't be scrambling to decide what to buy. You won't be frozen by indecision. You'll already know. You'll just be waiting for the price to hit your target. It's like going to an auction. If you don't know what you want to bid on, you're going to make mistakes. You'll get caught up in the moment. People often ask me what the best investment I've ever made is. They expect me to cite Coca-Cola or Apple, some stock that generated billions. And those were excellent investments, don't get me wrong. Apple in particular, I was slow to recognize its potential, but it has proven to be quite rewarding. But the truth is, the best investment I've ever made was in myself. I dedicated my 20s and 30s to reading, learning, studying businesses, visiting libraries, reading annual reports, researching other investors, and engaging in conversations with intelligent individuals. I didn't possess substantial capital back then, but I had time, and I utilized that time to improve my understanding. You see, that's the essence of investing. It's not solely about money. It's about knowledge. The more you know, the better the decisions you'll make. And better decisions, well, they compound over time, just as money does, perhaps even more rapidly than money does. So, if you're young, if you're just beginning your investment journey, don't fixate on accumulating a large portfolio. Focus on cultivating a robust intellect. Read voraciously. Learn how businesses operate. Study accounting, not the intricate aspects, but the fundamental principles. Learn to interpret financial statements. Learn how to think critically. Because when the crash inevitably occurs, those who have done their homework will be prepared. They'll know what to do. And those who haven't will simply be fearful. They'll be contacting their friends, seeking guidance, and their friends will be equally apprehensive. Now, let me share something that might surprise you. I don't think about money in the same way that most people do. I mean, certainly I possess a considerable amount of it, more than I could ever spend, more than anyone could ever spend, really. It's somewhat absurd when you contemplate it, but that's not my motivation. I don't awaken each morning contemplating my net worth. I don't examine my portfolio and feel wealthy or impoverished based on its fluctuating value. I engage in this pursuit because I relish the game. I enjoy discovering exceptional businesses. I enjoy watching them flourish. I enjoy the intellectual challenge it presents. It's like playing chess, but the pieces are companies, and the board is the entire economy. And the crash is simply a part of the game. It's a challenge, a test. Can you maintain your compo when everyone else is losing theirs? Can you discern opportunity when everyone else perceives disaster? Can you act decisively when everyone else is paralyzed? That's what distinguishes the competent investors from the exceptional ones. It's not intelligence, it's not education, it's temperament. Let me tell you about my partner, Charlie Munger. Charlie passed away not long ago, and I miss him dearly every single day. We worked together for, 60 years? Something along those lines, more than half a century. We spoke on the phone nearly every day, and Charlie was more intelligent than I am. I'll concede that readily. He won't mind me saying so now. He could anticipate events that I couldn't even fathom. He read everything: philosophy, psychology, physics, history, everything. And he synthesized it all in ways I never could. But you know what Charlie taught me that was most invaluable? He used to say, the big money is not in the buying or the selling. It's in the waiting. The waiting. You see, most people are incapable of waiting. They become restless. They become anxious. They feel compelled to do something. They want to feel productive. But the best investors are comfortable doing nothing, even for years at a time. They acquire a great business, and then they simply hold on to it. They allow it to grow. They allow it to compound. They don't monitor the stock price daily. They don't fret over quarterly results. They simply wait. And 20 or 30 years later, they awaken to find themselves wealthy. It's not complicated, but it's not easy either, because waiting requires discipline. It requires confidence. It requires ignoring everyone around you who's doing something different. You know, I often think about my father. He was a stockbroker and lost a considerable amount during the Great Depression. And I suspect that's why I became so fixated on not losing money. I witnessed the impact it had on him. I witnessed the impact it had on our family. And I made a decision at a young age, probably around 6 or 7 years old. I resolved to never experience that feeling, to never be in a position where I was desperate, where I was compelled to sell something because I desperately needed the funds. So I've always been conservative, perhaps excessively conservative at times. I have two rules. Rule number one, never lose money. Rule number two, never forget rule number one. People assume I'm joking when I say that. They laugh, but I'm not joking. You see, if you lose 50% of your money, you have to. I've seen markets crash time and again. Each time the refrain is the same. This time is different. People say it's exceptionally bad, that the system might not recover. I heard it back in '87, then in 2000, and again in 2008. And I know I'll hear it again. But you know what? It never is different. The details change, the narrative twists, but the outcome remains the same. The market recovers and business continues. The key, as I see it, is to avoid losses in the first place. That means patience, discipline, avoiding foolish risks, and not panicking when the market dips. It might sound unexciting, but believe me, it works. Now, about 2026, or whenever the next crash decides to show up. I can't predict the future, but I know crashes are inevitable. They're part of the deal if you're in the stock market. So, what will you do when it happens? Will you sell everything and hide? Or will you take a deep breath, pull out that list of companies you've been researching, and start buying? Because the ones who buy during the crash are the ones who prosper afterward. During every crash, you're going to experience fear, real fear, the kind that keeps you up at night, the kind that makes your stomach churn. And one of the biggest mistakes, in my view, is believing that investing has to be complicated. It doesn't. It's straightforward, though not always easy. Find a good business, buy it at a reasonable price, and hold it for the long term. That's all that's to it. Forget the noise, the talking heads, the hot stock tips, the market predictions. Just focus on the business itself. Is it sound? Does it make money? Will it still be making money in 10 years? If the answer is yes, then buy it and forget about it. I remember during the dot-com boom, everyone was making money on tech stocks. People kept asking me why I wasn't buying in. I told them, I don't understand them. They're outside my circle of competence. People thought I was old and out of touch, and for a while they were right. I was missing out. But I stuck to what I knew. Established companies, banks, insurance, consumer goods. Then the bubble burst. Those tech stocks plummeted, some to zero. Suddenly, being unexciting didn't seem so bad. The lesson? Stay within your circle of competence. It's to miss out. It's better to miss out than to lose everything. So as we look ahead to 2026, or whenever the next downturn arrives, remember these things. First, crashes are normal, even beneficial. They clear out the speculators, reset valuations, and create opportunities. Don't fear them. Anticipate them, prepare for them, and welcome them. Second, focus on businesses, not just stocks. When you buy a stock, you're buying a piece of a business. Think like a business owner, not a trader. Would you sell your business just because the stock market went down? Of course not. So why sell your stocks? Third, be patient. It's the hardest part, but it's also the most important. Wealth grows slowly, but given enough time, it compounds to incredible levels. I've been investing for 70 years now? I'm 94, maybe 95, I've lost track. I've seen a lot. Wars, recessions, booms, busts. And through it all, the stock market has trended upward. Not in a straight line, of course. There have been down years, sometimes several in a row. But overall, it's gone up because the American economy grows, businesses grow, innovation happens, and people solve problems. And if you own a share of that, you get to enjoy the rewards. Let me leave you with this. Investing isn't about being the smartest person in the room or having some secret formula. It's about being reasonable, being patient, and avoiding foolish mistakes. That's the whole secret. If you can do that, you'll be just fine. I've always believed that the real test of an investor is whether they can stay calm when everyone else is losing their heads. Can you buy when everyone else is selling? If so, you're going to be more than point. In fact, you're going to thrive and build significant wealth. It won't happen overnight, not even within 5 years realistically. But with time, through consistent effort, like a snowball gaining momentum downhill, it will happen. The snowball begins small, gradually accumulating snow as it rolls. It grows progressively larger, and by the time it reaches the bottom, it's enormous. That's the power of compounding, the essence of wealth creation. So when that market correction arrives, whenever it does, remember this: the crash isn't the end. It's a fresh start. Your opportunity to acquire outstanding businesses at remarkably attractive prices. Don't squander it. Don't allow fear to steal this opportunity from you. Someone once asked me what single piece of advice I would offer a young investor. After careful consideration, I replied, read voraciously and cultivate patience. That's the essence of it. Educate yourself, learn the landscape, and then patiently await the opportune moment. And when that moment arrives, act decisively. That's enough wisdom from this old man for now, I think. Go out there, do your due diligence, compile your watch list, and when the time is right, be courageous. Because on the far side of fear lies opportunity. That's where true wealth resides, and that's where you need to position yourself. I genuinely wish you good fortune. And always remember, it's not about timing the market. It's about your time in the market. Maintain your investment, stay patient, and remain disciplined. In 20 or 30 years, you'll reflect on the crash and realize it was the pivotal moment that changed everything for you. The moment you started building your fortune. Now, where did I leave my Coca-Cola. You know, some things never change.